Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I'm your host, Dominic Chu. It's almost a cycle now. While the markets float around these new highs, volatility is once again creeping back in. So joining me now is Roger Hallam, Global Head of Interest Rates at Vanguard, along with Jay Jacobs, U.S. Head of Equity ETFs at BlackRock. Now, Roger, Vanguard has long been, and I mean long been, known for passive index-based products. But you are very much getting more active, if you will, in actively managed ETFs, especially in bonds, an area of the market previously known for its relative stability. So maybe take us through, first of all, Roger, why Vanguard is getting more into active ETFs versus your decades worth of passive indexing DNA, and what exactly you hope to achieve by doing so more so in the bond market.
Sure. Well, I think investors are increasingly expressing a preference for the ETF vehicle. And we are looking to serve investors where they want to be. And so we have a very successful range of active mutual funds, and we are looking to expand our product offering into the ETF wrapper. We've now launched 8 active fixed income ETFs. We're about to launch our Vanguard Government Securities ETF, which will be our first focus on the government space. But really, it's a case of expanding our offering to meet client demand.
This client demand that's out there, ETFs and the demand for them, is no secret. It's been decades in the making right now. What exactly is, I don't want you to give the secret sauce away, Roger, with regard to what you're doing. But when it comes to somebody who is the global head of rates at Vanguard, can you take us through what the thinking or construct is by which you go and actively manage a bond fund? In other words, when do you start overweighting, say, treasuries versus mortgage-backed securities, or when do you flip around again? What are the types of things you are looking for to dynamically manage a bond portfolio of these different sizes?
Sure. Our active philosophy is we want to use high information ratio strategies to deliver repeatable returns for clients. And we do that in a very diligent, risk-controlled framework. So when we think about dynamic allocation, say, between government securities and mortgage-backed securities, we're looking for when those opportunities are asymmetrically skewed towards positive returns. And at that point, we will ask our sector teams to deploy risk within their sector, but not just from a beta perspective. We're very focused on delivering bottom-up security selection to ensure that our alpha generation is as high information as it can be, so that we deliver repeatable returns for our investors over the investment cycle.
All right, Jay, this is maybe something we're talking about a little bit more now with regard to the actively managed bond side of things, more so. They've been around for years. Active management when it comes to equity ETFs have been around or at the forefront, I would think, relatively longer than they have been fixed income. So when it comes to actively managed equity ETFs, what do you think are some of the similarities and differences between how those products are treated on the active equity side versus the active fixed income side?
Well, the world has shifted a lot in the last few years. I think, looking at a high level, you see more volatility, you see more dispersion across different sectors, different parts of the equity markets. And frankly, if you look at the last 10 years, just having beta exposure to the markets was a tremendous exposure for your portfolio, but that might not continue over the next 10 years. So we're seeing a renewed interest in active strategies. I would really decompose active into 3 buckets, though, when we're talking about the equity space. There's alpha-seeking active, which is really portfolio managers trying to beat a specific benchmark like the S&P 500. There's outcome-oriented active ETFs, which are trying to deliver a specific outcome, whether that's higher income or protection against the downside. And then finally, there's more exposure active. These are corners of the market that are maybe just more difficult to index. So when you look across that active equity landscape, there's a tremendous breadth of products, and there's a really renewed interest in getting active strategies into portfolios because of that volatility, dispersion, and potential risk of lower returns going forward.
Jay, how do you feel as though investors, whether they be retail folks like me or others around there, or registered investment advisors. How do you feel as though that kind of use of these active equity ETFs has evolved over time? And what exactly do you think the sophistication level is for, say, a retail investor to use actively managed ETFs as part of their portfolio?
Well, one of the great things about ETFs, which has been the case since day one, is that it democratizes access to so many different strategies and asset classes. So previously, strategies that maybe were harder to access, or there was investment minimums, or the tax efficiency meant they could only be used by institutions that were tax advantaged, that has largely gone away with active ETFs. We see them being used by end investors, by financial advisors, and by institutions really across the board. When you look at the reasons why, though, we talked a little bit about, the dispersion, but, other reasons, the tax efficiency of the ETF structure has been huge. We see that active equity ETFs are much less likely to pay out a capital gain than actively managed mutual funds in similar categories. We see that the accessibility is a major accelerant for active ETFs. We do see end investors buying active ETFs because it's, generally easier for them to access them than active mutual funds. And then finally, a major driver has been the growth of the model space. You've seen, just hundreds of billions of dollars pouring into ETF models that are scalable, repeatable, cost efficient. And increasingly, those models are adding active strategies to introduce new sources of alpha for their clients. So there's a lot of tailwinds between end investors, tax efficiency, and models, all really kind of leading up to this adoption of active ETFs.
Roger, how much in your mind of the demand for these ETF products on the active side of things has been more towards, to what Jay alluded to, the alpha seeking or outperformance seeking side of things, versus investors putting their faith in an active manager to help them kind of guard against some of the volatility and downside that we are seeing more so these days over the course of the last 6 months to a year than perhaps we've seen over the course of the last 10 or 15 years?
I think it depends on exactly what ETF they're allocating to. I think about certainly our active ETF range, we're focused on enhancing returns for investors around their benchmark allocation. So we're seeking to outperform our designated benchmark and deliver those enhanced returns for our investors. And of course, the important point here is we're focused on delivering positive net of fees returns for investors with low expense ratios so that investors can keep the majority of their return while minimizing costs. So I think it depends on the product, but certainly for Vanguard, we're focused on delivering high quality information ratio alpha that contributes towards investors' success.
Roger, can I follow up on that with one other point? The fixed income market has been a huge focus in terms of volatility over the course of the more medium to recent term over the last couple of years. We're coming out of an environment where we've been in this kind of zero interest rate or near zero interest rate policy since the great financial crisis. There seems to be a normalization play for macro forces in the market right now, including the Federal Reserve, about trying to see whether or not we can get to some kind of more neutral interest rate policy that kind of fits the macroeconomic narrative. This is a paradigm that has not existed prior to over the last 5 or 6 years because we've never engaged in this market in the way that central banks have since the great financial crisis. How difficult is it for a bond manager, an active manager with regard to fixed income, in navigating this kind of normalization vis-a-vis inflation, vis-a-vis economic growth, or the volatility that lies ahead?
Yeah, well, first thing, I think it's a great time to be strategically allocating for fixed income. As you said, we had a long period of very low interest rates. We look at the prevailing interest rates today, we think it's a very attractive time for investors to start strategically allocating towards fixed income. And then when we think about some of the volatility challenges, some of the policy challenges we're seeing from the central bank and indeed government policy, from an active manager, that is ideal. We want volatility to be able to make decisions, be able to evaluate the investment opportunities in front of us. And obviously, we're looking for those opportunities which we think we have insight to and that offer asymmetrically positive returns for our clients. And that's where we dynamically allocate our risk towards those opportunities where we are confident we can enhance returns for investors.
How difficult is it, Roger, to do that in an environment where you don't really understand what the movement out of Washington, D.C. will be with regard to not just the Federal Reserve and its head, Jerome Powell, but also to what the anticipated fiscal policy would be?
Yeah, I mean, obviously there has been a lot of volatility, you're absolutely right, but we're focused on the medium term. We're not focused on week-to-week volatility, and that's certainly what we've seen a lot, policies announced and then subsequently rolled back or extended deadlines. We're focused on those medium-term investment outcomes for clients, where we think we have the greatest insight and where we can position portfolios strategically to benefit our end investors.
Jay, have you seen anything with regard to the flows that you watch over at BlackRock with regard to where investors see the opportunities and or the heat, so to speak, in the coming weeks and months? So is there anything to glean from where people are positioning to say, hey, maybe these will be the trends going forward because the markets and investors are already starting to try to lean that way?
Absolutely. Two areas that come to mind. First is we've seen a lot of flows going into rotation ETFs. These are actively managed ETFs like DYNF or THRO that are able to very rapidly redeploy capital in the parts of the markets that our systematic teams see as being the most interesting. So in DYNF, it's really about factor rotation. Which factors are most likely to benefit in this current macro environment? Meanwhile, in Throw, it's really about what themes are most likely to work in this macro environment. So looking at things like belt tightening amongst consumers, where if there's a little bit more economic shakiness, how are investors going to reduce their spend to be a little bit more cautious in light of what's happening in the macro economy? Or when you look at businesses and how business spending is shifting, what kind of CapEx businesses are going to do better around artificial intelligence? So dynamic strategies have been huge. They're very active, they're tactical, and they're also very tax efficient within the active ETF structure. On the other side of the equation, on more of the fundamental business, we're seeing a tremendous amount of interest in artificial intelligence, really looking across the value chain at a fund like BAI, where investors see the long-term opportunity. They see the trillions of dollars that are likely to be generated from this economic opportunity, but they realize that just looking at mega cap tech names is not a very nuanced way of playing artificial intelligence. You have to look across the value chain, from data owners to semiconductors to AI platform developers, even to AI applications, companies that are introducing AI into their products today. So taking an active lens to such a massive theme like artificial intelligence has been very popular with our fund BAI.
Jay, the passive indexing ETF world is leaps and bounds, orders of magnitude bigger than the active ETF mold right now that you are referring to. Do you ever see an environment where you will start to see a little bit more parity, if you will? I mean, I don't know how long it will take, but will more people start to lean out of the passive indexing type instruments and more into active ones? And what exactly will it take for them to keep that transition momentum going to get away from indexing and more into actively managed funds?
Well, in the ETF space in the United States, we've seen active growing faster than index. Now, we see tremendous structural trends behind both. We still see a lot of assets moving into index-based strategies where investors are looking for low-cost, core, diversified, tax-efficient ways of building the core of their portfolio. But increasingly, we're seeing ETFs be the vehicle of choice for active exposures, for people that want to introduce alpha or outcomes or active exposures into their portfolio. So both are growing very nicely alongside each other. As I was mentioning, this environment with volatility, with dispersion, with more uncertainty, maybe forward returns that might not be as good as the last decade, really lends itself to active. So I think we're seeing a comeback in active right now, but it's really a comeback that's happening in the ETF structure because so many investors are looking for the tax efficiency of ETFs and looking for the accessibility and scalability of ETFs as well.
And Roger, as we talk about the use of some of these active products, especially when it comes to fixed income, how exactly would you envision investors of all types, whether retail or institutional, using some of these active fixed income products? Do they build around core passive positions and just use allocations to these types of instruments to achieve some of that outperformance? Or do you envision a time when people can just place a core holding in an actively managed fixed income product in the hopes that they will, again, just continue to beat an index overall?
As I mentioned earlier, we think now is the right time to be strategically allocating to fixed income. We think it's an important ballast for people's portfolios. And I think about the Vanguard Government Securities ETF we're launching this week, VGVT. We think that plays a key role in investors' portfolios. You think about an investor that has a relatively high allocation to equities, for example, or other risk assets. A government securities ETF acts as a solid buffer to that portfolio. If we were to see less favorable economic outcomes or volatility associated with geopolitical events, typically you see risk assets underperform in those environments. We would believe that an ETF such as the Vanguard Government Securities ETF would be outperforming in that environment. So certainly an opportunity there to act as a ballast for portfolios. The alternative might be if an investor with a core bond portfolio, they might want to be upgrading that portfolio, a little concerned that credit spreads could widen. Again, tilting the portfolio a little towards VGVT, for example, would be a way of adding safety and security to their core bond portfolio. So I think you can view it very much from a strategic allocation perspective.
And before we let you go, Roger, I'll ask both of you a similar type question. For you first, Roger, as the global head of rates, what exactly is the thing that you are most focused on for the second half of the year with regard to how it affects the dynamics in your market?
Yeah, I think it's that growth-inflation trade-off. The Federal Reserve has stated very much it's on hold. It's watching to see how that trade-off between its employment mandate and its price stability mandate play out. Now, our outlook for the second half of this year is that growth will slow. We will see the labor market continue to gradually cool. And in that environment, the Fed will have a choice between prioritizing the growth employment side of its mandate or the inflation side. Now, we do see inflation rising over the coming months. We think heading towards sort of 2.75% on a core PCE basis by year end. But we think the Fed will ultimately prioritize what we think will be a continued cooling in the labor market and want to provide some insurance. So we think the Fed will ease a couple of times towards the end of this year. We think that will provide a tailwind for bond, a tailwind for fixed income performance. And so we're confident in the outlook for fixed income and that we think, let's say, that clients should be allocating to fixed income right now.
All right, and Jay, similar question for you, except tilted towards the equity side of things, your area of expertise. What exactly is the thing that you are watching for the most in the second half of the year? Is that same macro narrative relevant to equity ETFs as it is to Roger's bond world?
Well, I think we're going to see a bit of a barbell here. On one end of the spectrum, I think we're still going to see a lot of money that's been in cash for a long time, $7 trillion in money market funds, start to inch their way back into the equity markets, but probably doing so in a really risk-minded way, using things like buffer ETFs, which can protect against the downside and still give a measure of upside performance. Our fund MaxJ recently reset, giving a cap of up to 7% exposure to the S&P over the next year. I think a tool like that is going to be very much in vogue for investors looking to get back into the markets. Now, at the other end of the spectrum, I think people are going to be playing offense, looking at powerful macro themes. We mentioned AI, but I also think infrastructure is going to be a very key area to look at as we continue to see geopolitics and fragmentation around the world impact markets. I think people are going to be looking at really powerful macro trends like the growth of infrastructure in the United States as a way to, place their bets in the equity markets where they have higher conviction.
All right, a fascinating conversation. I wish we had more time for all of it. My thanks to Jay and Roger for the conversation there. Thank you both very much. We've asked Jay to stick around for the ETF Edge podcast. You can catch that and all of our other content at etfedge.cnbc.com. Thanks for watching. We'll see you next week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from top industry experts. Sign up now at cnbc.com/ETF Edge newsletter.